What's up everyone, it's Karthik with MoneyVest. So I am now in Tbilisi, Georgia. So I took the morning flight from Dubai to Tbilisi. It's only 3 hours away, so I figured I'd travel for a little bit, explore some new places. So over the next week, I will be over here, but updates will keep coming in. I'll keep you guys posted and updated with where we are. If you want to follow along on my journey, you can also connect with me on Instagram. I've been posting a lot of stories over there. My handle is going to be CastWRP, with the link also available down below. So you got lots to unpack in this video, so please make sure that you drop a like and share this with your friends and family, other members, traders, investors, subscribers that you find that can benefit from this information here, because like I said, we've got lots to discuss with regards to NVIDIA's earnings coming out next week. We got recession, interest rate expectations. Everything is going to be very, very important for the markets moving forward. So when it comes to analyst recommendations, we've got 66 buy ratings on NVIDIA, which is actually quite crazy to think about. Only 8 hold ratings and 0 sell ratings for the company. And it has a implied movement for next week's earnings of well over 10 to as much as 13%. So this right here is going to be NVIDIA right there, perhaps one of the most important earnings for the entire market, not just for next week, not just for this month, not just for Magnificent 7, but pretty much the entire market. It's probably the most important stock. And I've got a $70,000 trade, options trade on NVIDIA. If you want to understand and learn more about options trading, this right here is the entire week 0. We're quite literally getting started, so this would be the best time for you to start and get going with us, and again, follow our progress. So link's going to be down below if you want to join, of course, with that 16% annual discount that's available for 1 more week. And this goes over exactly the trade that I've taken on NVIDIA and SOXL for next week. So my option is expiring next week on Friday. So link's going to be down below if you want to follow along on our journey for this options. And I will be sharing my options portfolio every single week. So this is the big burning question. Well, actually, there's 2 different questions. Number 1 is whether the Federal Reserve is going to be cutting rates by 25 or 50 basis points. And the second question is whether we're going to see a recession or not. I've discussed in my previous update, going over our Excel spreadsheet, that rate cuts, when accompanied with a recession, can, in a short-term basis, be a little bit more not so great for stocks, because we do tend to see a little bit of a pullback or slight correction in the S&P 500 in the 1 to 3 months. But in most cases, over a 6 to 12 month basis, we've seen very nice, very good recoveries from the market, with most instances 75 to as much as 90%. The markets are higher 1 year later on average by about 15%, or median gain of 15%. So the real question once again becomes, are we going to see a recession? And also, if the Federal Reserve is going to embark on this rate cutting cycle, or quantitative easing is about to begin, to what extent can we expect that? Because it is going to quite literally affect every single person. It's going to impact everyone in the world in some way, directly or indirectly. These decisions do impact everyone. I posted this on our Instagram as well earlier today. So this right here is the part of the dual mandate from the Federal Reserve. So this is exactly where they want to be, where inflation is constant and stable at 2%, and they've got unemployment really low at just a little bit over 1%. Right now, unemployment, I would argue, is right over here, and inflation a little bit over here. So we are at well over 3%, 3.3% for CPI inflation, and unemployment, of course, sitting well over 4.3%. So we're all the way up here. And the Fed's goal is to bring this circle down to its dual mandate, as both inflation and unemployment are stable and low, for the economy to grow, and of course for a healthy, stable, functioning economy. Now, the biggest challenge, as we've already addressed in our previous videos, is that they may be able to bring inflation down, but what if they actually start a rally in unemployment, right? If unemployment starts to go up, that's going to be a big problem for the Federal Reserve, right? So in other words, they can bring this down, right? But they can also push it outward to the right, where unemployment is increasing over here while inflation's coming down, right? So that would also not be good, because then in that situation, yes, we accomplished bringing inflation down, but we also triggered a recession at the same time. I've asked you guys a lot of these questions before in the past, and where do you think that we're going to operate in the future 1 year later? So quadrant number 1, quadrant number 2, quadrant number 3, or quadrant number 4? Comment down below in what your expectations are for where we're going to be in terms of the dual mandate. In my opinion, we're going to be somewhere around quadrant number 2 because unemployment is accelerating, and in my opinion, it is going to go higher, but not to a point where it triggers a recession. That is still well within control. And I got some other really important metrics to go over, which I've been keeping track of, and also another really interesting study from Bank of America, which we'll break down. This right here is market expectations for federal funds rate and what the expected cuts are going to be. As you'll notice that 30 days ago, we were expecting for interest rates to be higher at the end. So this is going as far as August of 2026, so 2 years out. And also fewer cuts were being priced in. But ever since we've seen the unemployment numbers come in a little bit higher than expected, and Jerome Powell's Jackson Hole Economic Symposium speech indicating a very specific directional move, the markets have, of course, become a little bit more bullish to the idea of interest rate cuts. And this curve essentially moved downward with the markets now pricing in more cuts and also a lower terminal rate at the end of this rate cutting cycle. In other words, August 2026, the markets are pricing in for just over 3% interest rates as opposed to well over 3.5 as they were expecting 30 days ago. Now, this right here, again, are the expectations going to as far as 2025, so just about a year ahead. And again, the market's pricing in for about 100 basis points. That's in my opinion, that's actually quite a lot in the next 4 months. So September, 76% probability for 25 basis point cut. Then we've got November for another 25 basis point cut, and then December is going to be 50 basis point cut. All in all, 100 basis points is what the market's pricing in. Now, Mohamed El-Arain basically says the market is pricing in too many rate cuts in 2024 right now. And I actually do agree with him because 100 basis points in the span of 4 months is a lot if there is no recessionary fears. Unemployment is accelerating. We have to give the people in the recession camp credit where credit is due, that unemployment is accelerating higher. However, there's a lot of indicators that are still very, very strong at the moment. Let's just go over to those indicators first. And one of them is going to be something like this right here. So if you take a look at unemployment, right? So these are some of the more important indicators from a number standpoint, from a quantitative analysis standpoint. You'll notice that unemployment, I've put that in yellow because right now we're at 4.3%. The last 6 months average is 4%. So we're definitely accelerating a little bit higher compared to the last 6 months average. Jobless claims, 232,000. The last 6 months average, 237,000. So there's no weakness being shown in jobless claims right now. Then if you come over to GDP growth, which is perhaps one of the most important metrics for understanding whether we're in recession or not. And this is also very much of a lagging indicator. I would say unemployment, lagging indicator, GDP growth, lagging indicator. Jobless claims actually tends to be quite a leading indicator for the market because it's more recent, more fresh. Earnings growth, also a very important metric. And the difference between these two over here is whether we see a earnings recession or an economic recession. There's two different things, right? Economic recession has more to do with the actual economy and the real world, like unemployment and jobs and all those things. Earnings has a lot more to do with the company and the market specifically, right? So if there's earnings decline, 2 consecutive quarters of earnings decline in the S&P 500, then it's set to be in an earnings recession. It's very different than an economic recession. But the last quarter, we actually increased by almost 11%, and we have been on a very, very nice, consistent increase quarter over quarter and even year over year for earnings within the S&P 500. When it comes to PMI manufacturing, now this is also in yellow, suggesting for some weakness that's coming in with the current reading at 48, last 6 months worth of reading at over 50. And then if you take a look at S&P 500 margins, we're sitting at 12.2%, which is also very high compared to its last couple quarters of averages at 11.5%. Actually, this is the 5-year average. So last 5-year average of 11.5% versus 12.2% is where we're at. I think that was a record quarter for S&P 500 in terms of its margins. This is as of second quarter 2024. GDP growth of 2.8%, last 6-quarter average of 2.8% as well. So it's been very, very strong and stable growth for the United States. And then S&P 500 in itself, in terms of how the market is pricing all that information in, whether it's forward-looking or not, we're seeing the last 6 months 10.7% return, and we're pretty much trading back up to all-time highs. And the yield curve is perhaps the only indicator that is in red, which is negative 11.9 basis points, and it's been inverted for well over 1,100 days, or just over 3 years. We've seen that inversion of the yield curve continue. So of all the indicators or metrics that you can perhaps look at, and I'm sure this is not an exhaustive list, but these are some of the more important numbers. Unemployment is flashing yellow. Then we've got PMI manufacturing index flashing yellow, and yield curve has been flashing red for well over 3 years. So it's very much, those are the only three that I would argue are suggesting for some weakness in the United States. Other indicators continue to show this economy is extremely strong. Now, the reason why recession, is so important for us to understand is because we already know how the markets performed when we get Federal Reserve's rate cuts and after the economy is in recession versus not in a recession, right? So not in a recession, we see after the Federal Reserve's rate cut, the markets continue to rip higher. And we see more gains and more quantitative easing, which leads to more spending, more investing, more gains and returns overall. Versus when the economy enters a recession after the Federal Reserve rate cuts, the story is completely different. That's why I think it's so important for us to really try to understand what are we going to witness, one or two, right? One is going to be the Fed rate cut in September without a recession, and the two is going to be Fed rate cut with a recession, because those are two very, very different scenarios in the market. Now, in terms of S&P 500 companies themselves in the second quarter 2024, how many of them have been citing quote-unquote recession has now dropped to a multi-year low. So we are now 28 companies only that mentioned the word recession in the second quarter 2024. But historically, this has also been one of the worst indicators to look at, because if you take a look at fourth quarter 2019, the earnings which were reported in January, right? Nobody expected a recession, but I gotta give a little bit of benefit of the doubt here because this was also COVID and nobody could foresee that pandemic. And as a result, 42 jumped to over 208 in just one quarter after the United States entered a recession in March of 2020, right? So the first quarter 2020 ended in March. So all the earnings that were coming out in April and May, a lot of companies cited recession. And of course, that number jumped to over 200. But then again, if you take a look at first quarter 2022, that number increased to over 113. That was up from 15. And then increased to 234. So there's a lot of selling pressure in the economy, in the markets per se, because we did witness the bear market of 2022, and yet we did not experience a recession. So over here, when corporate insiders or basically executives or S&P 500s in their earnings calls were not mentioning a recession, 1 month later, we entered a recession, which was the shortest recession. And in 2022, when corporate insiders and executives were so vocal, over 234 companies calling for a recession, we actually did not see one. So while they are very sort of accurate in their understanding of what the business world is doing, basically the supply chains, the manufacturing, the jobs market, the overall business, the health of the economy, they're not very good predictors of recessions. As I've mentioned, nobody really is. At the end of the day, nobody really knows what is going to happen. And our job is really try to understand, based on probabilities, how we can prepare for the best scenarios and even be ready, right? Regardless of whether we see one or not, just be ready. So this right here was from a strategist at BCA. A recession is coming in the US and a few rate cuts won't prevent it. So contrary to what many believe, investment research firm BCA Research sees the economy is on the cusp of a recession. There's things that are breaking down quite rapidly now. And reading further, they essentially mentioned that every single one of us now believes there's a recession. And that's exactly the opposite of what the market believes. And Evans pointed to signs of economy slowing down, including what he called the deteriorating U.S. labor market. So again, pointing to unemployment, which is flashing yellow. So, credits to him for, again, talking a little bit more about in that perspective. And also the U.S. manufacturing activity falling to an 8-month low in the same month. There's things that are breaking down quite rapidly now. And the few rate cuts are not going to prevent a recession. Average recession is 10 months. It takes some time, it takes something like a year before the Federal Reserve cuts actually start to give a boost to the economy. So that's true, because anytime the monetary policy shifts, whether it's quantitative easing or quantitative tightening, it takes time for that to play through the economy. The sentiment prices all that information in very quickly. So in other words, when rate cuts begin, the markets are going to be very optimistic around quantitative easing, but the effect or the impact of those rate cuts in reality takes time. It takes months because there is a lag effect of the overall rate cuts or even rate hikes. I would argue rate hikes actually get priced into the economy fairly quickly versus rate cuts, because banks want to hold on to those higher interest rates. They want to raise interest rates the first opportunity they get. But when it comes to lowering interest rates, they're going to take their sweet time. And this right here is also another chart that we have discussed before, that the S&P 500's annual percentage change has also been pretty brutal, along with the rate cuts from the Federal Reserve over here, when accompanied with a recession, of course. So this right here, again, when accompanied with a recession, rate cuts have oftentimes resulted in the markets not doing very well. But eventually, again, longer term, they continue to move higher and push up. This right here is another Bank of America study suggesting for all these different indicators, similar to what I just mentioned in one of my in the spreadsheet, but they've got more sentiment indicators and a few valuation indicators, and you can see that how many of them got triggered in these prior sort of cycles for recessions. And right now, this is where we are as of June 2024. The only ones we have really triggered at the moment are some consumer confidence and percentage of expecting stocks higher prior 6 months over 2. So consumer confidence, so mostly sentiment indicators. Another one over here is going to be the valuation. S&P 500 trading at a little bit of an expensive valuation, and then inversion of the yield curve, of course, I mentioned already, and tightening credit conditions as well. So those are the only 5 that we've hit so far, or in other words 50% out of 10 that have been triggered. And of course, we're trading pretty much at all-time highs. So, like I said, there are signs. I mean, if you were to make a case for a recession, there are signs for one, because unemployment is accelerating, PMI manufacturing index surveys are coming down, yield curve is inverted, valuation, you can make a case that it is expensive. And for that reason, I think there's also somebody talking about how there is a very expensive valuation. So US stocks are overvalued because of unrealistic expectations for AI-powered economic growth. Vanguard basically mentioned that, and they said that investors are too optimistic about their near-term prospects of AI. Firms would need to grow profit by 40% annually for the next 3 years to match valuation. This is double the annualized rate of return since 1920s, when the electricity lit up the nation. So those are, again, priced for very, very high growth here. And I think that goes back to our discussion of NVIDIA, right? NVIDIA is kind of like at the top of that chain, where it is priced for perfection. Valuation is extremely high, suggestive of this growth to continue. Now, some other indicators to also keep in mind is just business activity, vacations, people taking on leisure travel. So this is accommodation, airlines, and cruise lines, all of them pretty much dropping quite aggressively in the month of July, coming in since December, and they're all now under zero at the moment, right? So this is, again, suggesting for how activity overall, business activity, and people taking on vacations and just going out there and spending more time in those areas are starting to roll over as well. Again, some of the more behavioral indicators that we can look at. And again, markets also giving us some messages with bond, gold pushing higher. So, in an environment where gold pushes up to all-time highs, the bond market is also starting to perform better, and the dollar index is selling off. Tech stocks were selling off. That generally speaks the volumes in terms of markets positioning, going more from risk on to a little bit more risk averse to more defensive parts of the market. Moving forward, this right here was actually quite interesting from Bank of America as well. They mentioned that corporate buybacks are likely to peak soon, meaning that we're going to see fewer corporate buybacks moving forward, because the cash percentage of total assets for S&P 500 is coming down to really, really low levels. In other words, companies have started to deplete cash to really low levels, and they're only at 8.8% of total assets now currently in cash for these companies. And as you already would have guessed, a majority of that is coming concentrated from Magnificent Seven and mostly tech companies. So that's where we are. And, that's another sort of demand or buying going out of the market, right? Because you can kind of rely on corporates buying stocks when they are cheaper. But even if they are sitting on very little cash, 8.8% compared to levels that we have previously seen at well over 12 to 13%. So there's a pretty significant decline here in terms of their cash level. Then you're not going to see, this big buyer in the market anymore, which is corporates themselves buying their own shares. And September is coming up. So September seasonality is going to be in the cards very, very soon. So for the next week, August 24th to September 30th, in those 22 years of the last 50 in which the trailing year was plus 10%. This is how the markets performed. And really the focus is going to be over here, August 27th, all the way through September 9th. And you'll notice the return up. We were 15 times, we were up 7 times, we were lower with an average change of 0.3%. but the real losses actually begin towards the end of September. Last week of September is really when the losses begin, especially in the middle of September. So you can pretty much take a look at September 15th all the way to 30th. We've got, again, 15-7 here, but 6 and 16. So the last week of September is quite brutal, with an average loss of 1.14%, median change of -1% as well. So this right here is really what we need to be prepared for from a September seasonality perspective. This right here is going to be S&P 500 performance after a 10% January through July and a negative first 2 weeks of August, something that we are experiencing right now. And once again, if you take a look at the period between September 23rd and October 2nd, this is really the time, last week of September again, where we've seen more down years versus up years. So 6 to 10 is that ratio, with a negative average loss of almost 1% with negative 0.3%. But right now we're still up 14 to 2. And then, of course, after that, it's a very, very strong 7.2% gain on average, 7.2% on median, and 16 out of 16 times we are higher October through January next year, right? So those are very, very significant gains in the fourth quarter after October 2nd. Or October 27th. So October 27th is what they're accounting for over here. So finally, we come over to a few other things that I want to discuss in this video. I actually was, in my flight, during my flight, I was actually surprised to see Fly Dubai's entertainment. And they actually had a lot of magazines and things available for Bloomberg and different publications. And so I caught attention of a few different ones that, I really, really wanted to discuss. And that is this right here, which is the top 50 firms in the S&P 500, or basically in the US. So what we have here is the size is part of the problem. So in 1995, the market cap of the world's top 50 firms equaled about 9% of the global gross domestic product. And by 2023, that number has risen to 27%. And the founding fathers recognized the risks in that concentration. So that's one of the reasons why I think we are seeing more risk related to the Google split or the breakup. Microsoft, Meta, these companies continue to be under a lot of pressure. And the number of new members entering with wider moats in the technology space has come down significantly. We were well over 25 at one point, and now we're down to 14. This right here is a few more things that I want to discuss, which is smaller investors, retail investors. They are also exiting the markets at some decent space here. So if you take a look at what happened during the pandemic, of course, the pandemic era meme stock bump, more and more retail investors, started to invest in the market. And now take a look at this. As the markets have continued to be more volatile in 2022, especially, we saw, bear market from the S&P 500. So many investors pretty much quit during that time, and we're now pretty much coming back to that 15% level, which is the pre-pandemic level of involvement from smaller investors. In other words, retail traders or investors as a percentage of US equity volumes as well. So that's where we are. A few more things that I want to discuss, but I can leave that for the next video, for the next update. But the bottom line is that from a recessionary standpoint, there are some signs that are flashing yellow, in some cases flashing red. But the bottom line is, I think that is really where the focus needs to be. Even if you do get a 25 or 50 basis points rate cuts, the markets are going to see that as a positive. In my opinion, the markets are going to rally or push higher in the short term if we are not accompanied with a recession. My personal opinion is that the probability of a recession happening in the US over the next 6 months is high, because I've done a lot of analysis, a lot of historical breakdowns and data-driven research that do point to the idea that a recession is possible with high probabilities. If I were to bet on the recession, I would put down a 60 to 70% probability that we do see a recession within the next 5 to 6 months in the US if things start to really deteriorate from an unemployment standpoint. But that should not stop me from investing for the long term. If anything, that's going to prepare me for better buying opportunities, for discount buying opportunities, as I will continue to raise more cash, increase my buying power, and really just deploy all of that during times of recession, because that's where the best deals and the best discounts and the best bargains are going to be. So hope you all enjoyed this video, found it helpful. If you did, make sure you drop a like, subscribe to the channel. 16% annual discount is available until the end of this month. As always, happy investing. I'll see you all in the next video.